Thank you. Thank you very much for the invitation. It's a real treat to be here. And it was really a pleasure to read this paper. So this is my, if it works. You'll click, oh, yeah. It works slowly. This is my one-slide summary of the paper. The paper starts with a new empirical fact, and the fact is that the US wealth share increases in bad times, and the best example is during the global financial crisis. And the reason it increases in this paper is because the wealth is computed through using the stock market. The price-dividend ratio increases more in the US, or decreases less in the US than in the rest of the world, and the US dollar appreciates. So that means the foreign currency depreciates, the value of the foreign stock markets go down. So that gives us the empirical fact. But the most impressive part of the paper is not there. The most impressive part of the paper is in the model. Because they managed to write down a model with end countries, end goods, so in the endowment economy, not the production economy. But in this economy, you have time-varying risk premia, thanks to a habit. And they can talk both about quantities, exports, net foreign assets, and prices. And they can talk about all of that in closed form. And that's the first paper I see that can do this. This is a big achievement. So the model is pretty rich. Christian was nice. He didn't show you all the equations. I'm not going to be as nice. I'll show you the equations. It's pretty rich. There's a lot of assumptions. Particularly, some are a little bit difficult to follow. So what I'm going to try in my discussion is to look a little bit under the hood. But I want to stress that what they obtain is again impressive. We don't have so many models where we can talk both about prices and quantities, and this is one. So the model, as Christian showed you, is going to imply that in bad times, the US dollar appreciates and the US wealth share goes up. So I'll show you that. But what I want to do, again, is first give you a little bit of motivation. Why should we in finance study something like this? Because the story, as exactly the way Christian started, the story looks like an international trade paper. We all know that in the US, we import more than what we export, okay, big trade deficit. The flip side of that is that we seem to invest more than what we save, so we need to find the money. And how do we find the money? We find the money by borrowing it from the rest of the world. And so our liabilities with the rest of the world are increasing, and they reach pretty high level. Here I have all the liabilities in the paper. They look on me at a subset. And so we're talking about something above 200% of GDP. At the same time, the US invests in the rest of the world, so our foreign assets are also growing over time, but as you can see, there's a pretty big gap between the two. And this gap is the net foreign assets, how much we owe to the rest of the world, if you want. Now, this gap is moving over time, and it's not so easy to understand those variations. So let's try to do it relatively intuitively. Why is our net position vis-à-vis the rest of the world changing over time? Well, the first driver is because year after year, we run a trade deficit. So we need to finance it. But that's the international trade part of the paper. The more finance part of the paper is the second one. This net foreign asset position can change because of some valuation changes. So what we invest in can appreciate or depreciate because the dollar appreciates or depreciates, or just because in local currency things change and the value of these things change. Now, to show you that this is really important, let me do a very simple and classic thought experiment. Imagine that those valuation changes, basically what finance is about, imagine it doesn't exist. And so our net foreign asset position would just be the sum of all the trade deficit that we've experienced over the last 60 years. And it would look like this. That's the orange line. But the actual net foreign asset is the blue line. You see the difference between the two? We are actually in percentages of GDP, so we're talking about trillions and trillions of dollars. And so I think that's why finance has something to say about this question. How can we explain this kind of gap? And you see that sometimes positive, sometimes negative, it's changing. And each time it changes, again, we're talking about trillions of dollars. So I think that's exactly what the paper is about. Now, to give you a very simple example and to relate it more to finance, what I'm saying right now is that the US owes a lot of money to the rest of the world, to the tune of something like $14 trillion. But there's something pretty cute. At the same time, the rest of the world is sending us money. Like, we owe them something, but they still pay us in aggregate. And so how could this be? Well, this could work if you have a difference in returns between the return on our assets and the return on our liabilities. So let's take a very simple example. Pick a return on asset of 3.5%. That's applied to assets of $32 trillion. Imagine that our liabilities, we pay 2% on our debt. It's 2% out of $46 trillion. You do the math, we can still receive something like $200 billion from the rest of the world, which is exactly what we do. Finance is about returns. That's why we have something to say about this big problem. We shouldn't leave it to the macroeconomics or international trade. Now, when we see difference in returns in finance, we usually think, the first thing we think is risk premia. It must be that we are getting this high return because somehow we are collecting some risk premia. Well, that's possible. Not completely sure. That's possible. So if we are enjoying higher returns on our asset than what we're paying on our liabilities because we are taking on some risk, well, it means that in bad times, we need to suffer. We need to transfer some wealth to the rest of the world. Okay. Is that true? Well, we're going to discuss it. That's going to be part of the paper. The second thing that maybe is a little bit difficult and that the paper offers a solution to is the fact that usually when we transfer money to someone else, that person is richer. And in most models in international economics, when you're richer, you consume more of your own good. If you consume more of your own good, its value goes up. It's like saying the value of the foreign currency should appreciate. But that's not what we see in the data. What we saw during the global financial crisis is exactly the opposite. The dollar appreciated, the foreign currency depreciated. So there's kind of a tension in this story that the paper is going to try to is going to address, right? And the paper is going to replicate the huge net foreign asset position of the U.S. I show you with the U.S. borrowing risk-free in dollars and investing in risky assets. But it's going to add something. It's going to add the fact that in that model, the U.S. dollar can appreciate in bad times because the U.S. wealth share will increase. So let me try to show you how that works in the model. I'm not going to go for continuous time and goods, way too complicated. So let's go back to discrete time, one good. Simple. These are the log preferences. You have some habit, which means that what really matters to you is your consumption relative to some kind of subsistence level. Now, once you write this down, you know that the local curvature, local coefficient of risk aversion, depends on what we call the surplus consumption ratio, this distance between what I consume and my subsistence level. When my consumption is very close to my subsistence level, I'm super risk averse. That's basically what this model applies. Now, if you write the stochastic factor in this model, what you see is that it's going to have a very simple expression. It's going to be driven by the change in the surplus consumption ratio and the change in consumption growth. So in order to understand a lot of things in this model, that's what you need to keep in mind. The change in the surplus consumption ratio and the change in consumption growth. The rest, you can forget. Now, in the model, there are three key assumptions. As Christian showed you, there are some global and country-specific endowment shocks. With those country-specific endowment shocks turn out to be a little bit correlated, so they are not so country-specific anymore, but we can discuss that later. There's some consumption bias, and there is something that Christian didn't have time to show you, but it's really important. There's a law of motion that is, by assumption, you assume how the surplus consumption ratio is going to move over time. That's the key assumption I'm going to show you in a second with some hysteroscedastic shock. So if we go into a bunch of results, I'm going to try to show you why they made those assumptions and what do you get out of those assumptions. So the first one is complete markets. Why is it so important? Because as soon as you assume that markets are complete, you know what is the change in exchange rate. You write down the equation for a foreign investor buying some kind of foreign asset with a return R star. If you assume that the US investor can access the same asset, you have a second order equation. This has to hold for any asset you can think of. Markets are complete. There's only one way to price an asset, so it has to be that the change in exchange rate is equal to the difference in the two log stochastic significant factors. So it's pretty cool because I just show you what the log stochastic significant factor is, right? So now you just have to think about the difference in those two. So you immediately see what you need. If you want the US dollar to appreciate in bad times, It just has to be that the marginal utility has to increase more in the US than in the rest of the world in bad times. And so we need to write a model where this is true. By the way, if the US dollar appreciates in bad times, that means the foreign currency depreciates in bad times. It means that if you invest there, you lose money in bad times. That's the definition of risk, right? Losing money in bad times. So it must be that the foreign currency are risky. And so we need some ways to do that too. So in the model, in order to have the US dollar appreciating, it has to be that the US investor becomes more risk averse than the foreign investor. How does that exactly work? Well, it has to be that the US consumption becomes closer to the habit than the consumption of the rest of the world investor. I think this is actually driven by the fact that there's some heterogeneity in the way habits evolve over time, but we can talk about that later. Another thing that the model does, and I can show you why, the model can replicate the volatility of the exchange rate. You may think that's obvious. It's actually not obvious at all. It's very difficult. It's a big achievement. Why? From the definition of the exchange rate, from the complete market definition, you know that the variance has to be equal to the description on the right-hand side. In the data, the volatility of the exchange rate is 10%. We know that the stochastic factor has to be volatile. So if you want to match some kind of Sharpe ratio of something like 0.5, you need to have stochastic factors that are highly, highly correlated, like 0.99. It's very difficult to find macro variables that have a correlation of 0.99 across countries, right? That's the Brand-Cochran and Santa Clara puzzles. But here, it's going to work. It's going to work because the surplus consumption ratio has, by assumption, a factor structure with a common component and then some country-specific component. So let me show you this. This is the assumption that at first is a little bit difficult to read, but it's actually key. They assume a law of motion again for the habits. This law of motion has one common factor that makes the habits very volatile, thus makes the SDF very volatile, thus produce high risk premia. But that doesn't affect the exchange rate. That's the magic. Why? Because the exchange rate is the difference in surplus consumption ratios. So that common component, poof, gone. And so what remains is just the country-specific part of this law of motion. Very smart. They also have some heteroscedasticity, and that comes from the fact that if you want to produce time-varying risk premia, it has to be that the log SDF is heteroscedastic. So they have it here. Now, there's one thing that I could not completely understand in the model. It's the following thing. It's beautiful to make these global shocks disappear from the exchange rate and still have a big risk premium. But there's a problem. Think about it. If the exchange rate is only driven by country-specific shocks, if I invest in many countries, those country-specific shocks are going to average out. If they average out, there's no risk anymore. You see the tension? And so, well, it has to be that there must be some global shock that remains and that's still driving the exchange rate. And so there are some global shocks in the SDF on each country, and somehow countries differ in their exposures to those global shocks. I think, again, it's related to the assumption on the habits, but I could not completely trace it back. Now, last thing, 2 minutes? Okay. There's a little bit of a debate on this US wealth share. So what Christian showed you is the graph on the left. In their approach, the share of the world wealth held by the US goes up during the global financial recession. But there are other people who actually say the opposite, the exact opposite. So here I'm taking this paper by Maxime Sauzet. He also computes the wealth share of the US during the exact same period, and he says, no, it's going down, it's not going up. So how could these two things be true at the same time? It's because they don't compute wealth in the same way. I think they don't actually define wealth the exact same way. As Christian showed you, their approach to wealth is based on the price-dividend ratio. I take the price-dividend ratio and I assume that everything is going to scale with the price-dividend ratio. In what Sauzet and others do, they basically look at national accounts and try to follow the value of financial assets and housing. I think there's one way maybe to reconcile the two approaches, is to think about total wealth as the sum of human wealth and financial wealth. Financial wealth, let's assume that statisticians keep track of it. So I'm willing to assume that financial wealth goes down during the global financial crisis. Fine. But could human wealth go up in the US more than in the rest of the world? That would give us an explanation of the tension. So you have to think about what is wealth. Wealth is the present value of future consumption. Human wealth, present value of future labor income. Most likely in recessions, expected future income or expected future consumption goes down. So that's not going to really help. But what about the discount rate? So again, it's finance. So if you have write a model where somehow the discount rate on labor income, on total consumption goes actually down during the recession, then wealth will go up. So here's an idea. Maybe human wealth, you can compute it by discounting future income with long-term interest rates. Long-term interest rates actually did go down in the US more than in the rest of the world during the recession, and so human wealth goes up. So this is just one way maybe to reconcile the two findings. Okay, I'm up. I want to emphasize that it's a great paper. It's a big achievement to be able to write down this model and have this results. I didn't really give justice to the paper. The paper can talk about many things at the same time. So just if you want to remember something, you have a paper with cross-form solution on net foreign asset, net exports, but also risk premia. The paper can talk about wealth. It can talk about exchange rates. If I have 3 simple suggestions, would be like, let's go through a simple case so that we can exactly see how things are going. And let's explain exactly what is the source of heterogeneity in the exposure to the global shocks, because there must be there. And at the end, maybe discuss a little bit the wealth estimation. I stop here. Thank you.